So good morning, everyone. Welcome to this Protiviti and Robert Half collaboration forum. This is week 4 of our 2021 series, and it's great to be back with you all this week and to be inspired by you all once again. My name is Paul Middleton. I'm a Managing Director in Protiviti, and I'm joined here today by my colleagues from Protiviti, as well as by my colleagues from our sister company, Robert Half. Since January and until the end of March, we're bringing you another terrific series of debates on a range of topics that we hope will invigorate, challenge and inspire us all, and that are designed to bring us optimism in these tough times. For those of you new to our forums, we started these back in March of last year with the intention of creating a regular forum for business leaders where in the face of the challenges, the disruptions and the uncertainties you faced, you could talk to each other, learn from each other, challenge each other and gain confidence from each other's perspectives. 10 months have passed and the challenges, the disruption and the uncertainty remains and are arguably even greater. With lockdown 3, new COVID variants, hospitals stretched more than we can possibly imagine, and a vaccine programme taking hold, the health of UK PLC is more precarious than ever. Combine this with the effects of Brexit, political turmoil and the gloom of a lockdown winter, and it's easy for us all to lose perspective. So in this, our series 4, we wanted to bring you renewed perspectives, fresh insight and a healthy dose of optimism and confidence, as we still believe that within this adversity, with collaboration and the right mindset, lies opportunity for us all. To unlock this optimism and opportunity, we need to be bold and we need to be different. A common thread that's run through all of our forums and that's been a rallying cry for us here in this forum is that now is the time to think differently and to be actioning both big and small ideas. Put differently, if we don't drive change during this continued period of disruption, we run the risk of rapidly becoming irrelevant. So to help you do this, to help you drive that change, we'll be bringing you new speakers and new inspirators each week to kickstart a debate. In the following weeks, we have Paralympians, CEOs, innovators, disruptors, entrepreneurs, and many others who are driving inspiring visions and positive change. Next week, to help you through the half-term chaos, we even have for you Dr. Elizabeth Kilby, the clinical psychologist from the TV series The Secret Life of 5-Year-Olds, to be talking about neurodiversity, managing children and their digital media, leadership and other topics. All these great panelists will share perspectives that you can react to. And react is what we want you to do in this forum. This isn't a closed forum, and you're not permanently muted or expected to be a silent participant. This is a collaboration forum, and we want you to be here to be part of the debate, to hear your voice and to learn from your insights in the true spirit of collaboration. To get involved, you can raise your hand using the Teams button on the right-hand side, and I'll come to you, or you can write your thoughts in the chat. Or if you just can't contain yourself at 8 a.m. in the morning, you can take yourself off mute and let us all hear what you have to say. But please get involved as it's infectious. So without further ado, I'm delighted to introduce to you our lead inspirators for this week, Caroline Rainbird, Rich Wagner and Conor Lawler. Yes, we brought you 3 inspirators this week. And we've done that because we're looking at the UK financial services sector. And we're going to be delving into topics such as how the sector will serve as the backbone for our recovery, the emerging risks in the sector, as well as the opportunities for the sector to innovate and differentiate itself on the world stage and what this might mean for you. Our 3 panelists will bring different perspectives to kickstart the debate, and I'm very pleased to be able to introduce them to you now. First, I'm pleased to introduce Caroline Rainbird, who is CEO of the Financial Services Compensation Scheme, the FSCS. Caroline brings a wealth of global experience from a career spanning 30 years within the financial services sector, encompassing senior regulatory, strategic, commercial, operational, investment banking and client-led roles. Before becoming CEO of the FSCS in 2019, Caroline held senior positions at RBS, including as Managing Director of Regulatory Affairs, and prior to that, she held a number of leadership positions within ABN AMRO, Group Shared Services, Finance, Change Management and Structured Finance. And we're delighted that Caroline can join us today. Next, I'd like to introduce Rich Wagner, founder and CEO of Cash Plus Bank. And our congratulations to Rich and his team for being awarded their banking license just a few weeks ago. Cash Plus is a leading digital challenger bank with a focus on the SME market and with a 15-year track record of digital innovation and strong financial performance. Rich is a payment and banking industry leader in the UK who over his 30 years in the industry has created numerous groundbreaking solutions, that have driven innovation, not just in Cash Plus, but in the industry as a whole. And again, delighted and thank you to Rich for joining us today. Thirdly, I'd like to introduce Conor Lawler from UK Finance. UK Finance is the collective voice for the banking and finance industry. Representing more than 250 firms across the industry, they act to enhance competitiveness, support customers, and facilitate innovation. Conor leads capital markets and wholesale within UK Finance, having previously managed the Brexit work streams. Prior to joining UK Finance, Conor worked across a range of government departments, including HM Treasury, where he worked on financial crisis intervention schemes, and he was a member of the Government Economics Service. So with our three panelists this week, like last week, I'd like to tempt you all to look beyond the here and now and challenge yourself and our panelists around our collective opportunities, our collective confidence, and what we need from the financial services sector for our recovery. As this is likely to be key in defining how successfully UK PLC can emerge from the current disruptive forces. To help us from time to time today, I'll be calling on some of our Protiviti consultants to share some of their own research and perspectives on the themes we're discussing. But first, I'd like to welcome our panelists once again and start with you, if I may, Conor, just to give us your macro industry perspectives around what do you think some of the main changes are that you've seen in financial services consumer behaviour, as well as small business behaviour over the last 10 months?
Thanks, Paul. Before I kick off and get 2 or 3 minutes in, can I just check you can hear me crystal clear?
Absolutely.
Perfect. Thanks very much. Look, it's an honour to be on the panel alongside Caroline and Rich this morning. So thank you very much for inviting me. It's a very interesting question, Paul, and I think we can tackle it in a number of ways. I think we're a membership organisation. We've over 270 members, and that's interesting because it gives us an incredible perspective of how firms in the industry more broadly have adapted to, maybe not 10 months, but certainly since 2016, since the referendum and dealing with the global pandemic over the last 12 months. And for us, working with our membership, helping them prepare, and also being effective counsel where appropriate to Treasury, the bank, and the FCA in preparation for the UK becoming a third country has led to a myriad of views, of perspectives over the last couple of years, which we can touch on. And I think that then feeds into how our banks and our members and our financial services firms have been supporting their customers, one, preparing for the UK becoming a third country and operating outside the single rule book, but equally adapting as well to a global pandemic in the last 12 years, and understanding how banks and financial services firms have stepped in to support regional and local economies. I think is a very, very interesting story, which we should, I guess, touch on over the next hour. Look, I've been preparing with our members since 2016 for the world we're in now, and it's been an incredible journey. We have watched many major international firms prepare for the UK becoming a third country, which we're in right now. It has meant moving substantial operations to the continent, moving people, moving IT, applying for new authorization and licensing, a story Rich knows all too well, but not only doing it once, doing it across different jurisdictions. On top of all that, Paul, we have had to navigate very different, changing and evolving politics since 2016. And a question we consistently get asked is, well, what is the industry's position on Brexit or leaving the European Union now? And our answer has always been, fundamentally, you have a group of international firms and domestic firms that only want to serve their customers, and they'll do whatever it takes to serve their customers within the perimeters and laws that have been set for them. But when you have very different and evolving politics, and therefore different outcomes in the relationship between the UK and the EU, you have to adapt very, very quickly to that new environment. And I'll give you an example. From 2016 and 2017, we spent 18 months building a new framework for financial services based on a theme called mutual recognition, which would allow, not for the UK to synthesize or replicate passporting or maintain access to the single market, but give a decent level of access for EU corporates and customers to deep, liquid capital markets in the UK. And that was on the cards for a couple of months, but given where the politics ended up and actually the red lines and the want for legal and regulatory autonomy that the UK and the EU set, that wasn't to be. And therefore the industry had to adapt very quickly to new positions and a realization that actually the end goal here and the resulting trading cooperation was going to have very, very limited coverage for financial services. And that's where we are now. So you have many firms, many banks navigating laws and regulations by which they haven't had to look at for nearly 40 years. A lot of people don't realize, actually, once you pull back the layer of the single market and you're operating outside of the UK, the EU has a number of different market access regimes depending on where your client or customer is. So you could be a bank servicing a huge car manufacturing company in Germany. Even outside the single market right now, you might be able to offer a deposit and lending facility cross-border, but you couldn't offer the same product or service into France or the Netherlands or Luxembourg because their market access regimes differ depending on where your end client or customer is. So I think the banks and our members have been very, very resilient, an incredible amount of preparation, but equally their customers have as well. And depending on the size of corporate that you are, and if you have huge treasury operations and you have 5,000 or 10,000 staff, generally you will have the capacity to prepare for the environment that we're in now. If you're a smaller, an SME or a micro business, you don't have those resources, and therefore when our banks and members can step in and provide that counsel and service and support in preparing and helping our client and customers, their client and customers prepare for the world they're in now, that has led to a very interesting view and perspective over the last couple of months, Paul, watching those firms prepare for January of this year. I think the future relationship is going to be very interesting. We don't know where that's going to land. We're going to see a memorandum of understanding signed between the UK and the EU at the end of March. Will that result in a new financial services agreement? Absolutely not. What will it mean in practice? Probably a meeting of regulators 4 times a year to discuss things like equivalence agreements and future market access. So we're very much in a new world. But the one thing I will flag before handing over to Caroline and Rich, Paul, is that they're very clear position from the EU on setting up at stall, reducing dependency from the UK. And what we'd like to see in the UK side is a similar approach where we begin to prioritise UK domestic regulatory reform and gearing up for a world now where the UK is a leader, maintains its leadership in financial services, becomes incredibly competitive. And that doesn't mean reducing standards. That means high global standards, high transparency, but a very, very good reason and a very, very good story for firms and corporates to want to remain and stay in the UK. I think that's incredibly important, because if it's one thing this country does well, it's financial services, international financial services.
And Conor, thank you very much for that. We'll be building on some of those opportunities and themes you touched on, and some of those challenges later on as well. Caroline, if I just may bring you into this as well, just to look at it from a consumer perspective. Within the FSCS, you're obviously at the sharp end of seeing where customer outcomes and customer detriment is. Well, customer outcomes are not what it should be, and where customer detriment occurs. How have you seen the market and the market change over, let's say, the last 10 months, but also some of those time periods that Conor refers to? How have you seen that shift recently?
Thank you, Paul, and thank you for inviting me. And I'm looking forward to, along with Conor and Rich, contributing to the discussion. So, as you say, we are a compensation service for those consumers and ultimately our customers who have suffered at times very poor outcomes and very regrettable outcomes. So all our customers are extremely vulnerable. And ironically, for a customer-led organisation, nobody wants to be a customer of FSCS. So that's always an interesting way of balancing. But what we can do for those customers who do indeed have valid claims is to make sure that end-to-end journey is as efficient and as empathetic as possible. And that we can actually get people back on track and hopefully get them back into a very important sector in the economy with confidence. And ideally, again, unusually for a customer-driven organisation, we do not want those customers to come back to us, because then that will have meant that they haven't been able to have an ongoing good experience. So we also, a very important stakeholder is our levy payers, all nearly 40,000 of them, many of whom will be part of Conor's organisation, trade organisation, and Rich will be a contributor to our levy. And I'm sure it won't be a topic of conversation, but obviously our recently announced substantial levy is not something to be proud of, because for every penny that we pay out in compensation shows that there has been a bad and poor outcome for consumers. So there, we work very closely with our customers, with the industry, and also with the regulators who set our rules of being, and government as well. So we have an interesting, challenging stakeholder base that we work with. The nature of how customers come to us, which is after, sadly, financial services companies, authorised financial services companies have defaulted, means that, and clearly with the support the government has been giving across the sector, means that we probably haven't seen purely COVID-led collapses as yet, and we'll have to see how things pan out once some of the government support mechanisms are released, because many of our customers, challenges start a number of years ago. But what we are having to deal with as very much a live operational company, we had to transition to a fully remote workforce. Some of our claims handlers are also provided through an outsourced company as well. So that was an extremely challenging and unexpected start of or end of March, beginning of April, as we looked to how we could do that. Because in a crisis situation, what is really important and very important for what we do, whether that be a collapse of a depositor, an insurance company, or in a turbulent times, is that a compensation scheme such as ourselves has to operate each and every day to give customers confidence that we can get them back on track. So I'm proud to be saying and thank every single person across the organisation that we have not lost a day's production. And interestingly enough, our customer satisfaction scores have gone up. And I think it reflects the real importance and focus that customers and consumers generally look for reliance and stability in these really uncertain times. So, and we see the real sharp end of vulnerability each and every day. And, sadly have many sad stories. We also have good stories about getting customers back on track. But the reasons people come to us are really distressing. And that has become particularly pronounced where we have seen customers who are struggling with the loss of a collapse or a failed institution or product, and their challenges have just become exaggerated through COVID. They may well be dealing with a whole host of personal and professional challenges, and the compensation that they were entitled to was always going to be important, but becomes particularly meaningful through really challenging times. We've also sort of seen the sharp end again of our amazing frontline workers, because a number of our customers have regrettably been NHS workers and all sorts of frontline support workers. And we have, whilst recognising all our customers are important, we have tried to set up mechanisms to help. And I've been involved in exchanging correspondence with several frontline workers. Particular one that sticks in my mind was somebody who was working in intensive care, and the last thing he needed when he came home was to continue progressing his claim. So we've looked at ways in which we can help those customers who through this time have had particularly urgent cases. We've dealt with people who sadly have been in the middle of a claim and have become terminally ill, whether that be with non-COVID related or COVID related instances, and we always have sad stories, but they have been particularly poignant and very challenging for our people who are working remotely. We all juggle being at home, homeschooling, being all things to all men and women. So it's been a really challenging time, but I'm pleased to say that we've been able to be here for our customers, for our people, and do what we need to do, and highlight with our data and insights that we have some of the changes that need to happen across this industry to ensure that consumers have consistently better outcomes.
And that I think has been a theme that has come to the fore around kind of, the importance of those customer outcomes, and that, certainly in this forum we've discussed many times. So thank you for that, Caroline. Maybe Rich, coming to yourself, and it's essentially already in the chat we've seen questions around people asking like how the sheer volume of loan schemes that are going to the market, how that's going to change the market dynamic in the long term. But maybe Rich, if you can share some perspectives of some of the changes you've seen in consumer and small business behavior over the last few months, but also maybe just touching on some of the innovations that you've applied within Cash Plus Bank to meet some of these changes.
Yeah, no, thank you, and thanks for inviting me to the session. Always love to talk about Cash Plus, and just love talking about the industry. And certainly, you got to start with the unprecedented times, because that's the word of 2020, if not going to be 2021. But let me give you some tangible evidence of things that have happened through the 3 lockdowns, the pandemic. Some interesting things that I think we all expected, and actually some that I didn't expect. Not surprisingly, within each of the lockdowns that occurred, I think most of the financial services, especially in the transactional banking side, probably saw anywhere between a 25 to a 40% reduction in overall transaction volume. If you think about business current accounts or consumer current accounts, people just didn't have anywhere to go. And if I take my own personal experience of, the only thing I did was do my monthly or every 2 weeks order on Ocado, and that's pretty much the transactions. I mean, first time ever I had a credit card statement and a debit card statement that was like 5 transactions. Didn't have any Oyster transactions, so it was great to reconcile every month. But we are definitely seeing a significant reduction in transactions. Interesting, less reduction in lockdown 3 than in lockdown 1. So people are finding ways to spend, probably getting sick and tired being locked up at home. So they are doing that, and businesses are absolutely trying to find alternative ways to re-energize their business. The real hot topic, and I know UK finance has been hot on this, is in terms of cash. Making sure access to cash. I know it's the old thing. I'm a digital bank. Why am I even talking about cash? But cash is still a relevant metric, and people can go on to my LinkedIn and see a very old blog that cash is going to be around until well after I retire, and probably well after I go. I mean, yes, we are seeing a reduction in cash, but it still represents, the last numbers I saw, 40% of the UK economy is still transacted in cash. And you got the haves and the have-nots. You've got retailers that are actually enabled with merchant acquiring solutions that are preventing cash transactions, which isn't good. But then you've got merchant acquirers that are concerned about the SME that they're servicing, and they shut off their merchant acquiring solution. So if you see the small mom and pops around the area, because I do walk around my neighborhood quite a bit, that they only offer cash. And one of the reasons that they're only doing cash is their merchant acquiring relationship has been severed by their merchant acquirer. So kind of an interesting dilemma on cash. And the other element of cash, which I found very interesting, people talk about the reduction in overall ATM usage. That is somewhat true in terms of volume. People are using technically on a macro basis less cash. But the interesting thing is that the average transaction at an ATM has gone up. The number of transactions has gone down. And one of the reasons is, and I was at another conference once talking about the number of viruses and filth that actually sit on the 10-key pad of an ATM. And after going through that particular session, I don't think I've actually been to an ATM since March. So people who are actually using ATMs are taking out more money because they don't want to frequent and actually have an encounter in terms of proximity or such, and trying to reduce their exposure to COVID in that way. But cash has gone down less than what the media is saying, simply because people are being more prudent on when they go get their cash, whether it be at the post office or actually via an ATM. One area I've got a quandary with personally and professionally, and that is the reduction in lending. The overall receivables in consumer lending has gone down. Now, interesting. I on one side, I kind of raised my right hand, and I'm very proud of the British consumer of being responsible during an uncertain time of their inflows and income. And this is not just us. I mean, we saw a 25-30% reduction in our overall credit receivables, but that's not much different than some of the data that you'll see out of the Bank of England. There has been a significant reduction in overall consumer debt at this point because people are taking what may be slightly less income from their employer or from furlough schemes, but certainly a far less expenses. They're not going to the pub, they're not going on the tube, they're not having travel expenses, and thus the disposable income, I don't have a number for it, but certainly as a result of the reduction in consumer receivables in terms of lending, kind of gives you an indication that people are being responsible. Yeah. Good for the consumer, and I'm proud that people are doing it responsibly. For us, we want people to actually take our lending products and stuff. But I think in the main, I think people are being very responsible. The credit delinquencies, people paying responsibly for their credit products. The small credit card book that we have and overdraft book that we have, the actual delinquency performance is holding up extremely well, and we certainly put a reforecast together for COVID. It's performing well above that particular forecast in terms of very good behavior. We are cautiously optimistic. We don't know how much that behavior is being clouded by people on furlough. Certainly in lockdown 1, you had 9 million people getting paid, 80% of their salary, and many organizations like ourselves, if we did use furlough, and we did use furlough, and we appreciated the government's support on it, we topped up people to 100%. So, when that, I think Rishi's doing as good a job as he can. It's one of the toughest jobs in the country right now, trying to wean people off of the furlough program, and what happens when furlough actually goes away. What is the true underlying unemployment rate, and the ability to repay is something we're very keen on. So that's on the consumer. But on the other element of businesses, and this is a macro trend, record number of company formations at Company House. Record number. I mean, we're up, it's up 25%. It's a number we track very carefully because although many people don't know us, so hopefully more people do as a result of being a bank, we command about 7% market share of all new startups in the UK. So the number of startup organizations who are registering themselves as a limited company is an important factor, because we really do see our numbers, our new account volumes actually grow or shrink based on the new company formations that happen in this country. The different thing, the one interesting dynamic though is, well, why is there such a rise in company formations? I think individuals that are in full-time employment, are employed with a traditional employer, are concerned about their job. They are thinking, what's going to happen next? And so many of them are opportunistically setting up small company, one-person band company for contract, future contracting work and stuff. Because what we're seeing is, Cash Plus is seeing record number of current account sales for businesses. What we are seeing is record low number of activation of that card and actually putting money and transacting on that card. So they're literally getting it, holding it, and really just making sure that they're prepared for whatever the economy or this pandemic actually creates. But the net effect has been relatively positive for us, getting more customers to come on board and shortening that journey for our customers, and providing solutions for them that allows them to get onboarded much easier than what you'd find in a traditional bank. And last but not least, I would say from a dynamic, which is kind of for a e-money issuer that we were during most of the pandemic, and now a bank, certainly our mindset has changed, and this is around deposits. And now I can call our customer money deposits. I used to have to call them safeguarded funds, but now I can call them deposits. And thanks to Caroline, we can certainly talk about something that they're much more familiar with, which is the financial compensation scheme, as opposed to safeguarding. They understand Caroline's logo far more than they understand the FCA's rules and regulations on safeguarding. So that's a good good thing. Although, like, to be fair, when you look at the legal underlying elements of safeguarding is probably safer, safer than financial compensation scheme. But the recognition that the financial compensation scheme and the safety and security that particular logo provides to people is superior to anything that's out there. But as a result, yeah.
Sorry, Rich, interrupt. You touched on a few risks there, and that's very interesting because, and I'm just reflecting here. I just wanted to bring some of the questions from the chat, because on those risks points, there's people reflecting on that because, and maybe Conor, just to get your perspective on this first of all, because the world has changed, and Rich, you've given us a lot of stats there around, and we'll test people at the end to see if they were listening on that, but in the way the market has moved over the last few months, but there is residual risk there, and the risks are changing. And indeed, as Justin has commented in the chat, from a macro, I guess, reputational perspective, we've seen Amsterdam has ousted London as the top share trading hub. Conor, do you see a risk of London losing, and I guess the UK losing its reputational status as that top tier trading and city venue? And what other risks do you see there in the market from some of those trends that Rich has mentioned?
It's a very good question. So a couple of points to pull out, which I'll try and do in 2 to 3 minutes max. Paul, we need to remember the industry has been preparing like nothing anybody has ever seen since 2016. That doesn't mean UK financial services industry more broadly was completely inoculated from leaving the single market. You're leaving 40 years of laws and regulation. There will inevitably be some risk, some operational turbulence when that is happening. But one of the things we talked about in the prep, Paul, was about what has the sector learned over the last 10, 12 months, 18 months, 2 years, since 2016. That's simply prepare for the worst, but hope for the best. I know that's an overused cliche, but I think that is exactly what the industry has done. Make sure in all scenarios it can, to the best of its ability, serve its customer base. We have to give a hat tip to the UK regulatory authorities as well. I mean, the measures that have been put in place have actually worked, remember, right? So the big red flag and red risk here is financial stability from the UK and the single market, whether there's financial instability risk. And the measures that the EU have put in place for equivalents for clearinghouses and central security depositories, and the measures the UK have put in place here have been incredibly helpful and have softened what would have been a far bigger blow from leaving, from the biggest capital markets hub leaving the single market. I mean, this is pretty major, it's pretty material. The FCA have built a temporary permissions regime, very, very unique. So if you're a branch of an EU firm operating in the UK, you can still operate in the UK for up to 3 years. And after that 3 years, then apply for full licensing with the FCA and the PRA. No other entity across or jurisdiction in the EU has offered that. The FCA have also built temporary permission powers. So they've got a targeted forbearance tool. So if they look at the industry now and they see banks doing best efforts to comply with very new laws and regulations that have been onshored to the UK from the EU, but adapted for a UK setting, if they see firms doing their level best, but actually struggling for no fault of their own, they've got targeted forbearance measures, which they can apply to alleviate stress to customers, banks, and the market. Again, incredibly unique. And I think the regulatory authorities deserve a hat tip. Back to Justin's question about share trading and derivative trading. Yes, we have seen, but what we have seen is very predictable market fragmentation. If you're trading in an EU share equity of an EU company, and you want to meet an EU counterparty, you've got to go in an EU venue. It's no different to Borough Market or Spitalfield Market, right? It's a load of buyers and sellers. You've got people from the UK, you've got people from Europe, and you've got international people. Effectively, what the EU have said is, if you want to deal with an EU client or an EU product, you need to do it here. I mean, it's honestly no more complex than that. You can read 50 pages in the FT, but it is no more complex than that. And up until December, Paul, we've almost been shy about accepting the EU's ambitions here for rebalancing where London capital markets are to Frankfurt, Paris, or Dublin. But they've been very open about it now, and that's a very reasonable objective that they have. All you have to do is look to what Mairead McGuinness, the Financial Services Commissioner, said in December, and what she said in January, and then what the EU have published by way of an action plan. they want to rapidly reduce dependency on the UK. They have their main capital markets and liquidity hub operating outside of their rulebook, operating outside of the single market. And intuitively speaking, you would not want to have high dependency on fuel for your economy sitting outside your own jurisdiction. And they want to rapidly expedite that. So that's fine. But here's the final point I would land, Paul. If the EU were doing that, we need to worry less about EU reactions to rule changes in the UK. It doesn't mean we change all the rules immediately, but we need to start expediting regulatory reform in the UK to make sure this country remains competitive, serves its customers and maintains its high global standards, and starting those reg reforms in the context of global regulatory standards, IOSCO, the FSB, and working with the EU, I think is incredibly important. It's not a trivial point. It really, really matters.
Absolutely, Conor. And I think, Caroline, if I can maybe take some of those points that Conor's just raised, around regulatory reform, I mean, to yourself, again, from an FSCS, from a consumer perspective, are we doing enough? A question has gone in the chat around, has banking fraud increased? Where do you see the risk that is affecting your customer base at the minute? Where is there too much risk in the market?
Yeah, I'd just like to echo Conor's comment about the great support and innovation that our regulators do for us. It's extremely hard being a regulator, and actually, where it hasn't quite gone to plan always makes more exciting news headlines than where it works really well. So I think the regulator has an extremely difficult job, but they show great insight in many respects and are highly regarded. Turning to your specific question, in terms of what can we do as a sector through regulation to support consumers, I think it's a number of areas, and particularly in challenging, uncertain times, that is when you see a heightened focus on scams and frauds. And yes, we're seeing it. And what we collectively need to do is to do whatever we can do to drive those poor actors out of the industry. They are highly professional, highly sophisticated, and by the nature of what they do, one step ahead of us. So we do our best to highlight whether it be using real stories, obviously with all the right customer consents, but also use our data on a daily basis. We are reporting inappropriate activity to the regulator, and the regulator can take action. We are working with them around highlighting some of these scams, encouraging them to take action, and they are taking action, and will really focus on that going forward, because sadly we're seeing a much greater prominence of this type of activity. I think another thing that again, industry, regulators, government, and ourselves have a part to play is actually helping consumers to become better educated about the questions they need to ask on particular products when they're taking them out, making sure that they're equipped to make some of these, what might seem to us who've been working in financial services for many years, really simple questions. But the fact that people are struggling to answer those questions shows that we need to make things as simple as we can, and educate consumers to ensure that they go to the right places for the right products. We work in a very sophisticated financial services arena, and I suspect we've all been guilty of just making things too complicated and too complex. Yeah. And I think anything that we can do collectively to highlight some of the simple questions that consumers should be asking, particularly relevant in an environment that has had consistently low interest rates. People are looking for returns to ensure not to have some wealthy, opulent retirement, for example, but to have a relatively simple retirement befitting somebody who's worked all their life. And sadly, each and every day, we see the instances of where this has gone wrong. The old adage of if it's too good to be true, it usually is. It seems very simple when I look at some of the the claims that we're seeing, but unfortunately people don't know the right questions to ask. So we highlight that through the work we do. I know we link up with various trade bodies in the industry to highlight, but we need to do more. We have a very complicated market and a number of very complicated products. To be honest, the vast majority of mass market customers don't need to be going anywhere near that, but they're tempted in, whether it be through frauds, through scammers, or through a lack of knowledge. So our compensation bill just shows that there are too many poor consumer outcomes, and actually regulatory reform, industry sort of invoking mandatory minimum standards around poor conduct need to be looked at pace. We can spend hours and days and weeks and months talking about it, but we need action now, because these things will not change quickly. So sorry, Paul.
No, Caroline, that's fascinating, because I think you say that needs action now, and I think that then turns maybe to the flip side of some of that around the opportunity in this space, and the opportunity for banks, for regulators, for industry bodies and others to try and then make that difference and take us forward, balancing the needs of our customers, but also the opportunities that are now in front of us as well, and taking advantage of those. So Rich, I'd maybe like to bring you in again to talk about some of the opportunities that you see ahead, and just to warm us up on that, I'd like to bring in Theo from Protiviti. Theo, could you just share some of your perspectives around where you see the opportunities, particularly around the fintech space and in the market as a whole for us?
Yeah, sure. Thank you, Paul. So over the past decade or so, fintech has been redefining the finance sector globally, driven mainly by customer demand and technical innovation. And excitingly, the UK is leading the way in this space. The sector's become a huge strategic asset to the UK, and is really a key opportunity for UK FS in terms of its future outside of the EU and its post-pandemic recovery. Currently, the fintech sector employs around 75,000 people across the UK, contributing over £7 billion annually. And last year alone, the sector actually attracted over $4 billion of investment. So we can see that the fintech space is quickly becoming more than a subsector in the UK. Since the referendum, there's been a chorus of commentators who have been predicting the UK will lose this position in fintech and will be left behind by other countries who regard the sector as one that has real strategic importance to their economies. However, the UK's proposition in fintech is really unique. There's a pool of world-class talent and expertise, access to capital, with only the US attracting more fintech investment worldwide, and forward-thinking regulators, with the FCA being a real world leader in its support for innovation in this space. The UK is also home to one of the largest clusters of financial and professional services firms, and a consumer base with one of the highest fintech adoption rates globally, providing huge partner and customer opportunities for these firms. As a city, London is hugely unique. It's a financial services centre like New York, a policy and regulation centre like Washington, DC, and is home to thousands of tech companies like Silicon Valley. It's a combination that's not easily replicable. If we want to maintain this position, the UK really must not rest on its laurels and risk undermining this successful industry. Last year, the Economic Secretary to the Treasury, John Glenn, launched a review into the UK's fintech sector, which aims to establish priority areas for industry, policymakers and regulators to explore the ongoing success of this sector. Really excited to see the outcome of this review, which is actually due later this month. So if it interests you, keep an eye on it, as continued support and investment in this area will enable the UK to remain the best place to establish and scale a successful fintech business.
Thank you very much for that. Rich, coming back to yourself, to take in what Theo said there, as a digital challenger bank, where do you see the opportunity? You know, we've had Jess Straley from Barclays during the week saying that the UK now needs to look at Singapore and New York, where we need to compare ourselves and drive towards. Where do you see that the UK can now keep its most competitive edge in this sector?
Well, I definitely agree with Theo in terms of being the heartbeat of the fintech sector, and even when Brexit happened, I mean, we are funded by a U.S.-based private equity firm, Silicon Valley, so literally 7,000 miles away. And I will say our investor director will say that London, not Silicon Valley, London is the center of fintech, which is a pretty strong statement coming from a U.S.-biased perspective. So I think there is a strong pedigree. I am a little nervous. Certainly, I was not a big fan of Brexit, but as Colin says, you got to live with what the vote said and figure out how to make opportunity out of it. Innovation comes from differentiating yourselves in the marketplace, and I think within the banking sector, I think there's a really good suite of neo-challenger banks that are out there. I certainly praise and condemn their strategies from a standpoint. There's great stuff that's being done and stuff that I just don't agree with, and certainly the concept of creating something that is good for the customer, but also good for the shareholder and good for outcomes from the regulator standpoint. My view is I've got three stakeholders I got to make happy, and I think they share equally in that. And I think some of my cohorts out there in the Neo Challenger Bank have been looking at situations where it was only for the customer, which isn't a bad thing, but you can't go through life losing 50 to 100 million pounds a year and still be in business. And I think you need to have a healthy balance. And I think innovation comes from actually ensuring you understand the needs of all the regulators or all your stakeholders, including the regulators, who actually are quite innovative. Hey, I have nothing to say bad about the regulators. Here I am sitting as a regulated bank authorized on the 3rd of February during a lockdown and a global pandemic. I mean, that takes some ingenuity, innovativeness from a regulator that I suspect has not been happening in other countries. So I'm very happy with their actual approach. And in terms of opportunities, the one stat that I didn't share is there are record deposits sitting on balance sheets right now. There is a huge pent-up demand, and I'm not normally an optimist in an environment where I think there will be some recessionary tendencies, but the country is sitting on a huge pent-up demand of deposits, people saving money, and it's just sitting there. We're sitting on 80 million pounds of just SME grants that were given to our SMEs for which they're in lockdown and they can't spend. And so there is this huge pent up element of the government has been very supportive of these individuals to make sure that they can survive, but even they can't spend the government grants fast enough because they're in lockdown. But as with these lockdown initiatives ease, the innovation comes from people like us, hopefully, that actually have the data capability of getting tools and banking solutions to these people faster, and the technology to allow them easy access and a frictionless journey that allows a opportunity to take a leverage of these particular financial services products. And I think having credit solutions and transaction solutions that have been matured over the 15 years that we've been in trading puts us in a really good position. So I'm actually quite bullish about the industry. Certainly, I'm certainly looking forward to the Prime Minister's discussion at the end of February and how do we get out of this lockdown. The country has done a great job on vaccine, giving optimism to individuals. And I think there is the one thing we do have is, I don't know when the lockdown will ease and when we will go back to what would be a new norm. But when we do, there is an absolute pent up, M1 money supply that is ready to be deployed that I think will provide a V-shaped return to the economy. Whether it can be sustainable is another question. But I do think when that happens, we should see a relatively good spike, positive spike, and that should create positiveness for the economy and for those that operate within the economy.
Thank you, Rich. And certainly that V-shaped recovery spike is something we discussed here with John Ashcroft and others who've appeared in this forum. And it'd be interesting when John comes back in a couple of weeks to hear if he agrees with that. But Conor, if I may just come to you on that. So Rich is bullish, I think. Has talked about the prospects of that, the UK economy to bounce back. And from his perspective, balancing those different requirements for his stakeholders. Do you share that bullishness? And where do you see opportunity? And you're on mute.
I think so. I've managed to survive since March with avoiding the you're on mute. I've just been caught. So close to the end. Look, I'd agree. I would agree with Rich. Before I give my view, I mean, this COVID crisis has destroyed a lot of businesses, a lot of people's income, and that must not be forgotten. But there was one very interesting point that Rich made, and that is the level of cash deposits and savings that some parts and pockets of the economy are sitting on, and there's got to be something to that if we're thinking about opportunities, about increasing interest in investment and savings and more innovative uses of cash as opposed to it sitting on balance sheets. But more on that later. Look, the UK is an incredibly innovative country. It does financial services very, very well. The rule book that we look at and see in the EU was primarily developed by the UK. I mean, EU counterparties, member states were highly dependent on UK officials in drafting the rules that we are currently abiding by today. I saw that from the other side, spending some time in the Commission on state aid ahead of divestments in government-owned assets. I mean, the expertise was all sitting in London, and we shouldn't underestimate that. It's an incredibly resilient sector. We've got 2.3 million people working in financial and related services. 1.1 of those are working across banking, fund management, and insurance. And then another very interesting stat is 2/3 of that 2.3 million are working outside of London. It's not just a London-centric business. It's an incredibly resilient, long-standing industry that's growing, but it's benefiting all parts of the United Kingdom, and we shouldn't forget that. There are definitely some opportunities, and we've already seen some flavors of those opportunities from initiatives that the government has released and notified back in June of last year. The Chancellor's statement in November. And some of the initiatives we've seen, back to Theo's point about fintechs, for example, we've seen the Khalifa review released by the government, looking at how fintechs can better list, come to the UK, stay and derive capital and liquidity and grow their business here. We've seen Lord Hill, an ex-Financial Services Commissioner, just opened his review into listings in primary markets. How do you convince a Spotify to list in London as opposed to New York or Asia, and making sure that we make it as easy as possible without reducing standards for companies to want to come to the UK because it's an international hub is incredibly important. The next statement's a little bit provocative, and I don't mean it to be, but I don't think the competition is yet Europe for London. It's not Frankfurt or Paris. The gaps in capital and liquidity and that shopping centre style approach where everything is one collective hub. I think Europe wants to get there, but it's 5, 10, 15 years off. But we shouldn't underestimate their ability to get there. The competition is New York and Asian markets. And if we increase the cost of business of doing in the UK for an incredibly flexible business like financial services, you can't see them, you can't feel them, they're not tangible objects, and they move cross-border depending on regulatory barriers. You can pick up and move your business to any part of the globe. We should not underestimate that. The UK government shouldn't underestimate that. And that's the important with expediting regulatory reform now and making it very, very clear to the industry that this government is serious about building a regime that is fit for purpose for fast-growing international financial services firms. We've got building societies here which are very unique to the UK. Why not have a capital regime that suits them, not a one size fits all model? We need to have a talent regime here. When highly skilled people can join financial and related professional services in the UK. It shouldn't be costly, it shouldn't be expensive. So we need to get to work. We need to get to work on that. We need to implement some of the findings of the listings review that Lord Hill will have developed. And we can't forget tax. It's lower tax rates in New York and Frankfurt. It's not the right time to be having that debate, I don't think, right now, but it's an important long-standing point. Yep. The industry has been debating for a long time. If you increase the cost of business, you will cause a board of a bank or a corporation to think, if it is cheaper to do business elsewhere and it's more strategically beneficial, it at least creates a debate as to where they further invest their time, energy, and money.
Conor, thank you. Part of being able to grasp those opportunities that you've referred to, Rich has referred to, is a thing we've discussed many times here, and that's also just empowering our people from the top down through the organisations to drive that change. And I'd like to just switch towards looking at diversity and inclusion within FS, which is a theme we've discussed many times here. Maybe Caroline, just come to you on this, because FS companies, financial services companies in the past have come under a lot of scrutiny for a lack of board diversity as well as employee diversity. And even in 2020, there's an Oliver Wyman report highlighting that that progress has been made, but there's only 20% representation of women on executive committees and maybe 23 on boards. Maybe just coming to yourself and to Rich for perspectives on this, and recognizing we've only got a few minutes left, but do you see positive trends in this regard, and is enough being done?
Yes, this is probably a topic that could fill a whole separate session, and incredibly important. And I've been in financial services for 30 years, and being female in financial services is a great opportunity, but it's also it's not been easy, but I've seen substantial change. And I'm a firm believer of the fact that actually it's about a diverse range of people who bring the right skills and experiences and expertise to a role, not just because you tick a box in a certain category. And I think that has to be, having the right people in the right roles has to be the lead around this to give it real authenticity and longevity. I'm really proud working for an organisation that has a board that is currently 66% female, just about to increase to 66%. And I provide leadership across our executive team that is currently 55% female, about to increase to 60%. That is because we've got the right people in the right roles, but we've also looked very carefully at diversity in its widest sense of the word. Our customers are extremely diverse. If we don't have diversity of thought, diversity of input, we won't be able to serve those customers. And it's not just gender; it covers a whole host of areas, and it is really important that we focus it throughout the organisation, and we spend a lot of time talking about this, ensuring that we have the right calibre of individuals right from the top. So we're role modelling a predominantly female board, and we have some extremely talented board members in our board, and I'm really excited and delighted to be working with those individuals. So I can see each and every day, either with my executive team or through the organisation, the importance of diversity and what diversity brings. It brings a richness of conversation. It means that we can serve our diverse customers. So we're possibly a slight exception to some of the rules in financial services, but I think it's talking about it. There's many reasons why, if you're talking about gender, why women have found it challenging to work through, and there's a whole topic there. It's about having role models. It's about having the right environment. It's about supporting. It's about giving confidence. But 30 years on, I'm still here in financial services. There's a way to go, but we are making progress. And I think some of the positivity that comes out of a challenging situation, different ways of working, how we'll return. We're now seeing people working for FSCS, to Conor's point, across the UK, and we've said that's okay to do because we can. It's the right thing to do. How we'll make that work when we come back into the office, whatever that means, we'll work it out at the time. Yeah. So it's a really important topic that we probably can't do justice to, but it's great to be able to talk about it.
It's we're not going to go, but Rich, I'd like to bring you in for 60 seconds of perspective on that as well. Are we doing enough?
Well, there's more that needs to be done, and I would confirm with Caroline. I believe it's as much. I mean, you look at our board; it's not the right diversity metrics, and we know that. We're consciously going out to do something about that, and we find very good candidates, and certainly we are looking forward to appointing a new chair of our audit team who will be female. But it doesn't stop there, because I think there is still amount of diversity activity around the BAM environment, the ethnicity element. We may end up with probably 2 female board members, 30% representation, but I think people can criticize us that when we get to that point, we may end up with an all-white male or all-white board, which actually isn't good either. So I think it's a constant evolution, and there's not much, you have to make the positive steps. There's not going to be a revolution. It's an evolution, and hopefully we can move forward in that way.
Thank you, Rich. We've run out of time. Conor, Rich, Caroline, I'd really like to thank you for your thoughts. It feels like we could go on for a very long time with all of the discussion threads here, but thank you very much. You generated a lot of talk, a lot of discussion in the chat. I'm sorry if I didn't come to everyone's questions, but I hope you found that useful. I think there's been some fascinating perspectives today. And if you'd like to get in contact with anyone here, you can find them on LinkedIn. And please do get in contact. I'm sorry if I didn't get to your question, but there will be a video of our session today posted on our website if you want to go over some of what you've heard, and especially some of the stats we've heard. Next week, as promised, Dr. Elizabeth Kilby bringing us some more timely half-term insights on neurodiversity in the workplace, managing children with digital media, and many other topics. But I'd just like once again to say thank you very much to Caroline, to Conor, and to Rich for today's discussion and debate. Is fascinating, and thank you so much for all the perspectives you brought. So until next week, on behalf of my Protiviti and Robert Half team, I'd like to extend our best wishes to you all. Stay safe, be bold, be kind to each other, and we look forward to seeing you all next week. Thanks very much, everyone.